Okay, let's just get this out of the way right off the bat and bust a massive myth. You know the one, the idea that you can just click a button, go to sleep, and wake up a millionaire with literally zero effort. We've all seen those flashy, completely unrealistic ads, right? Well, forget about them. Welcome to this explainer. Today, we're taking a ruthless, totally reality-based look at the ultimate guide to passive income in 2026. We're drawing from extensive data, market reports, and real-world frameworks to give you a genuine, workable blueprint for building reliable income streams. So if you want to know how the modern wealth engine actually works, you're in exactly the right place. Okay, let's dive into this. Here's our roadmap for today. First, we'll look at the passive income reality. Second, building scalable digital assets. Third, the content monetization stack. Fourth, investing in financial assets. And finally, number 5, starting your income engine.
All right, kicking things off with Section 1, the passive income reality. We're going to look at the actual mechanics behind the myth.
Now, you might be wondering, what is truly passive income? Because let's be real, it's not money just magically dropping from the sky while we sleep. What is it? Well, according to the research over at Idea Proof, here is the absolute baseline definition. Passive income isn't a fantasy, it's a structured system. It requires a heavy upfront investment. You're either pouring in your time and effort or you're investing your capital. But the beauty of it? Once that initial heavy lifting is out of the way, the system eventually generates revenue on autopilot. It's basically a build once, sell forever situation. And this brilliantly illustrates the two distinct pathways or crossroads we all face when we start this journey. On one side, we have digital assets. Now, this path demands a ton of upfront time and skill, but practically zero capital. Think creating templates, courses, or guides. On the flip side, we have financial assets. This route requires significant upfront capital and a whole lot of patience, but very little daily time commitment. Think dividend stocks or real estate. Today, we're actually going to master both sides of this equation. Moving right along to Section 2, building scalable digital assets. Let's talk about sweat equity in 2026. $250 billion. Just let that sink in for a second. According to Idea Proof's 2026 data, that is the value the creator economy hit back in 2025. That is the massive, almost unbelievable size of the pie currently up for grabs for digital product creators. The market demand is just staggering right now, and digital products represent the absolute most accessible path to earning money while you step away from your desk. Why? Simply because the internet's distribution networks are already built for you. Now, what's really interesting about this slide is how it perfectly contrasts the trade-offs of every digital asset. Sure, video-based online courses have an insanely high revenue ceiling, often hitting tens of thousands a month for the top creators. But the difficulty is off the charts, taking anywhere from 40 to 100 hours of upfront production effort. Compare that to something like Notion templates. The difficulty drops down to medium. You can honestly make your first dollar in just a month or two, and your startup cost is essentially zero. A dedicated portfolio of, say, 15 quality templates can generate an incredible $5,000 to $20,000 a month. But hey, if you aren't keen on building a massive, exhausting video course, you absolutely have to understand the compounding power of volume. Relying on one single generic product rarely changes a life, but an ecosystem of products, that absolutely can. Take Canva templates. Selling just one template won't cut it. You need bundles of 50 to 200 templates targeted at hyper-specific niches like real estate agents or wedding planners. For Etsy printables, the top sellers are boasting catalogs of over 100 evergreen products like budget trackers. And print-on-demand merch? That is entirely a volume game. You literally need hundreds of niche designs uploaded across platforms to see meaningful, compounding passive sales.
Okay, Section 3, the content monetization stack. Here is how you build a 4-layer stack without totally burning yourself out.
Let's move to this and see how it builds layer by layer according to the Solopreneur framework from Workborn. Step 1, always start with affiliate marketing. You recommend tools you already use and earn commissions. Why do this first? Because the data from what your audience clicks on is literally free market research. Once you see what they're actually buying, you move to Step 2, building your own digital products in that exact same niche. Step 3 is email monetization, where you use automated sequences to nurture readers into buyers completely on autopilot. And finally, Step 4 is display advertising, which is just a really nice passive bonus once your traffic starts scaling up. And the best part? With 2026 AI tools handling the heavy lifting of content repurposing, one single person can easily maintain all 4 layers.
All right, shifting gears completely for Section 4, investing in financial assets. This is where we learn to make your money do the work for you.
So looking at the wealth-building framework from Grow Bean Sprout, they refer to this as your income pot. The entire goal here is stability across all market cycles. This pot relies on reliable portfolio payouts from assets like blue-chip stocks, established, super stable companies like major banks that yield around 3 to 6%. It also uses income ETFs and Singapore Real Estate Investment Trusts, or S-REITs. You can even sprinkle in some alternatives like peer-to-peer lending. But as analyst Jean Gallia points out, the landscape has completely shifted. Back in 2018, near-zero interest bank accounts pushed everyone into risky P2P loans just to find some yield. Today, well, with government bonds and high-yield savings actually paying out decent money, your income pot needs to be way more strategic.
So the crucial point is, how do we beat those baseline bank rates? We need compelling returns. Enter the 6.2% forward dividend yield projected for Singapore REITs in 2026, and that's according to institutional research from DBS Bank.
Take a look at this chart from DBS, specifically the yield spread. That spread is basically just the difference between what these REITs pay out and what a completely safe 10-year government bond pays. Because of global inflation fears and this whole higher-for-longer interest rate environment, meaning central banks are keeping rates elevated to fight inflation, REIT share prices have definitely taken a hit. But actually, this has widened that yield spread to a super attractive 4.0%, which is well above the historical average of 3.4%. What does this tell us? It means the market is already priced in the pain, giving new investors a historically supportive entry point and a fantastic premium for their capital.
But as you'd expect, not all REITs are created equal. The market is really separating the pack into growth versus yield positioning right now. The growth leaders are the platforms truly primed for recovery. These are structurally stronger REITs with rock-solid balance sheets, pricing power, and really prudent capital management. In fact, DBS specifically highlights grade A office and logistics sectors as being the absolute best position to defend their cash flow and keep growing their payouts even with some economic road bumps ahead.
Which brings us to Section 5, starting your income engine. Let's break down your 3-step action plan. All right, here is your final, actionable 3-step plan, bringing together insights from both Grow Bean Sprouts and PassiveIncome.net. Step 1. Secure your safety buffer first. Build a liquidity pot of emergency cash. Please do not invest your rent money. Step 2. Start small. Seriously, don't try to build a 100-hour course or buy an entire commercial complex on day 1. Just launch one single Notion template or buy your very first block of blue-chip dividend stock. Step 3. Ruthlessly reinvest. I mean it. Use a dividend reinvestment plan, or DRIP, to automatically buy more shares with your payouts. That turns your initial cash into a snowball of accumulating wealth. Or use your digital product sales to fund your income pot. Let compounding do the heavy lifting for you.
I just have to share this absolutely fantastic quote from the researchers at IdeaProof. Perfection is the enemy of passive income. A launched product earning $100 a month beats a perfect product still on your hard drive. I mean, I love that so much. We really have to stop overplanning. Stop waiting for the perfect market conditions. Just get your asset out into the world and let it start working for you today.
So what does this all mean for you? Well, it leads to one final provocative question. Which passive income engine are you going to start building today? Are you going to lean into the digital sweat equity of templates and courses, or will you deploy your capital into the compounding power of financial assets like REITs and dividend stocks? The blueprint is out there, and it's entirely in your hands now. Thank you so much for joining me for this explainer. Get out there, start building, and I'll see you in the next one.